Hello and welcome back, guys. So today, what we are going to be talking about is the conceptual framework. It is an article which was published in SPR technical articles. So let's have a look at it, and then we'll get a basic concepts about. So what's in the new conceptual framework in comparison to 2010, and then what are the new things that have come up in 2018. So let's have a look at it. So in March 2018, the International Accounting Standards Board finished its revision of the framework for financial reporting. The primary purpose of financial information is to provide, or the primary purpose of financial information is to be useful to existing and potential investors, lenders, and other creditors when making decisions about financing the entity and exercising rights to vote on or otherwise influence management's action that affect the use of entity's economic resource. The framework sets out the information needed to assess management stewardship and separate this from the information that users need to assess the prospectus of the entity's future net cash flows. So chapter 1, the objective of general purpose financial reporting. So what is the purpose of general purpose financial reporting? It is to assist the IASB to develop and revise its standards, as we have studied this many times. So it's in 2010's thing as well. So other thing what it does is that it assists entities to develop consistent accounting policies when no standards applies to a particular transaction or event, or when a standard allows a choice of accounting policy. So and those that's the second thing that what it does, and assists all stakeholders to understand and interpret the standards. So three things it normally does. So what are they? So basically the first thing is that it assists IASB to develop and revise its standards. Second is that it allows it allows or it helps to develop accounting policies when no standards apply to a particular transaction. So when a particular transaction is not particular type of transaction is not mentioned within the standard, then you always go back to conceptual framework and then look at it. Or otherwise, when the standards allow, then also you look at the conceptual framework. So we basically choose a standard which provides more relevant information. So that's the basic thing behind it. And then after that, it assists all stakeholders to understand and interpret the standards. So basically, it is the guiding principles behind those standards. Okay. So that will help us to understand and interpret the standards more properly. So IFRS takes precedence over the framework. It even says over here. However, should new IFRS depart from framework, the IASB will explain the reason in the basis for conclusion on that standard. When considering the objective of general purpose financial reporting, the board introduced the concept of stewardship. That's the new concept. This is relatively minor change, and as many of the respondents to the discussion paper highlighted, stewardship is not a new concept. The importance of stewardship by management is inherent within the existing framework and within financial reporting. So this statement largely reinforces what already exists, right? So how will the users make their assessment of returns? So it is basically the amount, timing, and uncertainty of future net cash flows to the entity and management stewardship of the entity's resources. So based upon cash flows and then the management stewardship of the entity's resources. Okay. So chapter 2, qualitative characteristics of useful financial information. The framework sets out the qualitative characteristics of useful financial information. However, these characteristics are subject to cost constraints and is therefore important to determine whether the benefits to the user justify the cost incurred by entity providing it. Okay, so these characters are subject to cost constraint, the qualitative characteristics. So if the cost of reporting something is greater than its benefits, then you don't have to follow it, or you try to minimize it. The framework clarifies what makes financial information useful. That is, information must be relevant and faithfully represent the substance of financial information. So just the cost is higher, that doesn't mean that you uh, can like basically report any figures which are not relevant and faithfully represented. So those are the two fundamental qualitative characteristics, as we know already: relevance and faithful representation. So the four enhancing characteristics are verifiability, timeliness, and then after that comparability, and then understandability. So whilst the qualitative characteristics remain unchanged, the board decided to reinstate explicit reference to prudence and substance over form. So prudence is introduced in support of principle of neutrality for the purpose of faithful representation. So in faithful representation, prudence has been mentioned. So what is relevant? Anything which is material is considered as relevant. So what is material? Materiality is the omission or misstatement would influence the user, that is considered material. Okay, so in case of prudence, it is introduced in support of principle of neutrality. Okay, so prudence is understood here as the exercise of caution when making judgments under conditions of uncertainty. Users find this concept important as they feel it should help counteract the natural optimism bias of management. So suppose when you're making a prediction, right? So when they actually give you the prospectus or whatever that is, so they normally are biased to, so they believe that um, the company will generate more funds or like more cash flows. So those are the projections, right? That's only projections based on optimistic assumptions. So it might not be, so just to minimize that optimism level, so suppose the growth rate was 12%, so let's say they might be very hopeful. Just to reduce that particular optimism by a bit, prudence is important, just to apply the caution. So when you're cautioned, so you might consider the factors that might be affecting the cash flows, right? So in that way, gives a bit more clear, or it represents proper picture of financial probable cash flows. So users find this concept as they feel it. It should help counteract the natural optimistic bias of management, as it says over here as well. By acknowledging neutrality and prudence, the framework includes conceptual underpinnings for the development of IFRS. Okay, so the board concludes that substance over form was not a separate component of faithful representation. The board also decided that if financial statements represented a legal form that differed from the economic substance, they could not result in faithful representation. So substance over form. So it's not only the legal form or who controls it. So who reaps the benefit out of it? That's more important as well. So it's basically, you can think about cell companies which are only registered in terms of legal things. It's not substance over form, right? So whilst the statement is true, the board felt that the importance of the concept needed to be reinforced. The board felt that the concept needed to be reinforced, and so a statement has now been included in Chapter 2 that states that faithful representation provides information about the substance of an economic phenomena rather than its legal form. Many standards, such as IAS 37, which is provision, contingent liabilities, and contingent assets, right, apply a system of asymmetric prudence, right? Asymmetric prudence. So in IAS 37, a probable outflow of economic benefits would be recognized as provision, whereas probable inflow would only be shown as contingent assets and merely disclosed in the financial statements. Therefore, two sides in the same court case could have differing accounting treatments despite the likelihood of payout being identical for either parties. So what we do is in IS 37 is that, so there are basically four cases, right? So one is probable, possible, and then after that there is a remote, right? So after that, what you normally do is that in case of probable, in case of probable, in case of probable, and then in liabilities you recognize a provision, right? Whereas in case of contingent assets you don't recognize anything, so you just disclose it as contingent asset. So even though the probability is pretty much similar, even though the probability is pretty much similar, we don't actually apply it, like it's not identical, okay, even though the probability is same, right? So that's what it's trying to say. So many respondents highlighted this asymmetric prudence as necessary under some accounting standards and felt that a discussion of the term was required. Whilst this is true, the board believes that frameworks should not identify asymmetric prudence as a necessary characteristic of useful financial reporting. The framework states that the concept of prudence does not apply a need for asymmetry, such as the need for more persuasive evidence to support the recognition of assets than liabilities. It is included a statement that in financial reporting standards, such asymmetry may sometimes arise as a consequence of requiring the most useful information. Many users would prefer the concept of measurement reliability, but the framework provides clarification concerning measurement uncertainties, which are defined in terms of faithful representation. Faithful representation of information does not mean that the information must always be accurate in all respect, as the use of estimates are an essential part of preparation of financial information, and this does not necessarily weaken the usefulness of the information. The framework strikes a balance between relevance and faithful representation in order to provide useful information to the users of financial statements. So there should be a balance between relevance and faithful representation just to provide a useful information, right? So there should be a persuasive evidence just for the recognition of the assets, even though the probability is same. So the probability criteria has been twisted, so whichever provides us more faithful faithful representation of the actual picture, that's what we normally consider, and there should be more evidence of assets. So if so, the probability criteria has been removed, right? So the information with a high degree of uncertainty should be replaced by information whose estimation involves less uncertainty, as long as explanations are provided. See, so when there is high level of uncertainty, it is better not to use it. So whereas in case of estimation, which reduces that uncertainty, so when there is a reduction of uncertainty, so something is, if it is wholly uncertain and then something which is less uncertain, so this is good, right? The which one which is less uncertain, which has less uncertainty. So that's what it's basically trying to say. So IASB states that a faithful representation provides information about the substance of an economic phenomena instead of merely providing information about its legal form. Okay. So in chapter the financial statements and the reporting entity, the board relates to the description and boundary of a reporting entity. So it basically relates to description and boundary of a reporting entity, right? So the board has proposed the description of reporting entity as the entity that chooses or is required to prepare general purpose financial statements, right? So it is useful to users to understand that general purpose financial statements are prepared on the assumptions that the entity is a going concern If this assumption is not appropriate, they are prepared in accordance with a basis other than IFRS or in breakup basis. So the framework explains that this assumptions means that the entity has neither the intention nor the need to enter liquidation or cease trading in the foreseeable future, which is 12 months. So the framework also states that the financial statements are prepared from the perspective of the reporting entity as a whole, not from the perspective of some or all of entities users. So when we say financial information, what is its objective? So you say like it is about providing information to lender or potential investors or current investors, and then after that lenders or creditors, right? So that does not mean that you prepare information just for these three parties. Okay, so you not for only creditors or suppliers. So there is a trade-off that you make, so you strike a balance between all this information, so you prepare it from the whole. Okay, so as an entity as a whole, not from the perspective of some users only. Okay, so this is a useful clarification for users, because in practice, the perspective taken in drafting various standards is not always clear. Okay, so when you're um, setting us new standards, so this basically helps them, because they don't have to actually focus on what kind of clauses to be put, so that some information are given to particular users, so they have a clear framework for establishing what kind of information to be provided and to whom. So chapter 4, so the board has changed the definition of assets and liabilities, which is, as you can see, 2010 definition: the resources controlled by entity as a result of past event from which future economic benefits are expected to flow into the entity, right? So whereas in 2018 definition, a present economic resource controlled by entity as a result of past event. So it does not say that the future economic benefits will flow or anything. So it does not say about that. It says a present economic resource which is controlled by the entity as a result of past event. Okay. So what is economic resource? A right that has the potential to produce economic benefits. Okay. So it does not always mean that the economic benefits are expected. Expectation is not there, but it has a potential. So in case of liability as well, the definition has been changed. So a present obligation of entity arising from past event, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits, right? So whereas now a present obligation of the entity is to transfer resources as a result of past event. So the present obligation, which is always there, so of the entity to transfer an economic resource as a result of past event. Okay, so in assets, what we said, a present economic resource controlled by the entity as a result of past event. So what is economic resource again? So we have used the term economic resource, which is the right that has the potential to produce economic benefits. So in this case as well, economic resource, so uh, the rights that we have which have a potential to produce economic benefits has been transferred, because even though if it's a cash, right, so you have transferred that. So suppose you have a present obligation of something, let's say a loan or something, so you transferred your cash, so that's an economic resource which is being transferred. And so what is that particular economic resource? That also, it also has a potential to produce economic benefits, right? So during this discussion, so some of the other concepts that the people have mentioned is an entity's obligation to economic transfer and economic resource must have the potential to require the entity to transfer an economic resource to another party. Have the potential to require. So this is what the supporting concept has been proposed, but the board went with this one. So in case of obligation, the board has says a duty of responsibility that an entity has no practical ability to avoid. So the entity cannot avoid it. So let's have a look at it. The board has changed the definition of assets and liabilities, whilst the concept of control remains for assets and present obligation for liabilities. The key change is the term expected has been replaced by, for assets, expected economic benefits has been replaced with potential to produce economic benefits. For liabilities, the expected outflow of economic benefits has been replaced with potential to require the entity to transfer, right? Potential to require the entity to transfer economic resource. The reason for this change is that some people interpret the term expected to mean that an item can only be assets or liabilities if some minimum threshold were exceeded. So it means that suppose it generated more than this threshold of cash flows, then only it is considered as assets or like similar of that sort. So people would basically interpret it in that way. So board has made a clarification, as no such interpretation has been applied by board in setting IFRS standards. This definition has been altered in an attempt to bring clarity. The board has acknowledged that some IFRS standards do include a probability criterion for recognizing assets and liabilities. So for example, IS 37, provision, contingent liabilities and contingent assets. So that a provision can only be recorded if there is a probable outflow of economic benefits, while IAS 38, intangible assets. So in case of, for example, in case of IAS 37, so which states that a provision can only be recorded if there is a probable outflow of economic benefits, right? Whereas in case of intangible assets, highlights that development cost to be recognized, there must be a probability that the economic benefits will arise from the development. Okay, so these proposed changes to the definition of assets and liabilities will leave these unaffected. The board has explained that these standards do not rely on an argument that items fail to meet the definition of assets or liabilities. Instead, these standards include probable inflows or outflows as a criterion for recognition. So the board believes that this uncertainty is best dealt with in the recognition or measurement of items rather than in the definition of assets or liabilities. Yes, because it's not a question about the definition of assets or liabilities, because of course in case of assets as well, so there will be a in case of liabilities as well, so there will be a provision that you will be required to make if there is a probable outflow, right? But still it is a liability, so the definition has not been affected. So in case of contingent assets as well, the probability of economic benefits is there, and it is an asset as well, but we just don't know that how. So what will be the measurement, or when will we recognize it? So it's a problem about recognition, not the definition of assets or liabilities, because we know that provision is created because will occur, so that's already a liability, right? We know that liability is a liability. In case of development cost, we know that it's already an asset, but we just don't know how much the probability. So how much will be the probability that we need to recognize it? So it's about recognition, not the definition. So that's what it has made clarification on about. So similarly, in case of chapter 5, recognition and derecognition, The board has confirmed a new approach to recognition, which requires decisions to be made by reference to qualitative characteristics of financial information. The board has confirmed that an entity should recognize an asset and liabilities or any related income, expense, or changes in equity if such recognition provides users of financial information with relevant information about the assets and liabilities and about any economic or about any income, expense, or changes in equity. Okay, so a faithful representation of assets or liabilities and of any income, expenses, and changes in equity, and the information that results in benefits exceeding the cost of providing that information. So if these three uh, objectives are met, then you can recognize assets, liabilities, or income or expense, anything. Okay, so the probability has been replaced by this qualitative characteristics. So if it provides a faithful representation of the true picture, then you recognize it, and then if it provides relevant information, then you recognize it. So, and if it's information which whose benefits exceeds its cost, then recognize it. Okay. So a key change is the removal of probability criterion. This has been removed as different financial reporting standards apply different criterion. For example, some apply probable, some virtually certain, and some reasonably possible, right? So this means that it will not allow specifically prohibit the recognition of assets and liabilities with low probability of an inflow or outflow of economic resource. Just it does. So what this normally did was it gave the clarification that something with low probability should not be recognized is not the case now. So you can recognize it as well, but it should meet these three objectives. Okay. So this is potentially controversial, and then the framework addresses this specifically as chapter 5 paragraph 15 states that and assets or liabilities can exist even if the probability of an inflow or outflow of economic benefits is low. The key point is here relates to relevance. If the probability of the event is low, this may not be the most useful information. The most relevant information may be about the potential magnitude of the item, the possible timing, and then the factors affecting the probability. Okay. So what's the magnitude of that item, and then the possible timing, and then the factors which affect those probability. So if all these factors are positively affecting the probability, then you can recognize it. Okay. So these three things, it says potential magnitude, and then possible timing, and then the factors. Even stating all of this, framework acknowledges that most likely location for item, as this is to be included within the notes to financial statements. So likely location for items such as this is to be included in notes to financial statements. Okay. So finally, a major change in chapter 5 relates to derecognition. This is an area not previously addressed by framework, but the framework states that derecognition should aim to represent faithfully both the assets and liabilities retained after the transactions or events that led to derecognition, including any assets liability acquired, incurred, or created as part of transaction or other event, and the changes in entities, assets, and liabilities as a result of transaction or other event. Okay, so should the framework states that derecognition should aim to represent faithfully both assets and liabilities which are retained, and then the changes in entities, assets, or liabilities as a result of a particular transaction or event. Okay, so which are retained, and then which they what's the change that has happened. Chapter 6, measurement. So the selection of measurement basis must take into account the key characteristics of useful financial information, which is relevance and faithfulness, and then and particularly the characteristics of elements, the contribution to cash flows due to economic activities, and measurement uncertainty and the cost constraint. So the balance is needed between giving entities the flexibility to provide relevant information that faithfully represents the entity's assets, liabilities, equity, income, and expense, and requiring information that is comparable both from period to period and across entities. So there should be a balance between faithfulness and comparability as well. Effective communication is also supported by considering that entity-specific information is more useful than standardized descriptions, and duplication of information in different parts of financial statements is usually unnecessary and make financial statements less desirable. So this is basically what happens is, when in SMEs, so when the auditor makes a auditing opinion or something, so what they basically used to do was they used to copy paste it, right? So otherwise, even in like when they are making a particular disclosures, it used to be pretty much like a standard, not entity specific. So that does not make it a bit um, faithful representation, that's what you can say, because it's not entity specific. So that's basically very vague and broad, which does not give any particular information to the users. The first of the measurement bases discussed is historical cost. The accounting treatment of this is unchanged, but the framework now explains the carrying amount of non-financial item held as historical cost should be adjusted over time to reflect the uses in the form of depreciation or amortization. Okay, so alternatively, the carrying amount can be adjusted to reflect the historical cost is no longer recoverable, so impairment. So it should basically, what it says is that it should represent the present amount or the uses that has already happened. The financial items held at, so that's for the case of non-financial item. The financial item held at historical cost should reflect subsequent changes such as interest and payments following the principle often referred to as amortized cost. Okay. The framework also describes three measurements of current value, so which is fair value, value in use, and then current cost. So fair value continues to be defined as the price in an orderly transaction between market participants. Fair value is defined as entity specific value and remains as the present value of cash flows that an entity expects to derive from continuing use of an asset and its ultimate disposal, right? So in case of current cost, it is different from fair value and value in use, as current cost is a entry value. Okay, so this looks at the value at which an entity would acquire the assets at current market price, whereas fair value and value in use are exit value. So fair value would be, so there might be some cost to sell, so that will reduce the fair value, right? So whereas in case of current cost, the value might be a bit higher than fair value. Okay, or like the exit values, because there will be cost to sell. So focusing on the values which will be gained from the item. So current cost is different from fair value, right? That's already been done. So relevance is a key issue. The framework says that historical cost may not provide relevant information about assets held for a long time. That's true as well. and are certainly unlikely to provide relevant information about derivatives. In both cases, it is likely that some variations of current value will be used to provide more predictive information to users. Okay. Conversely, the framework suggests that fair value may not be relevant if items are held solely for use or to collect contractual cash flows, such as PPE, which you normally don't is solely held for use and to collect contractual cash flows, right? So it does not need to represent historical value. It does not need to represent current value, right? So alongside this, the framework specifically mentions items used in combination to generate cash flows by producing goods or services to customers, as these items are unlikely to be sold separately without penalizing the activities. A cost-based measure is likely to provide more information as the cost is compared to the margin made on sales, right? So otherwise, what might happen is that so it might not provide her more relevant information because the margin gets reduced, right? You can say in case of inventory, right? So if net realizable value is used, then the changes in the net realizable value might actually it's a lower off, but still like it might um, give us a fluctuating margin. Chapter 7, Presentation and Disclosure. So this is a new section containing the principles relating to how items should be presented and disclosed. The first of this principle is that income and expenses in the statement of profit or loss, unless relevance or faithful representation, would be enhanced by including a change in current value of an asset in OCI. Okay, so income and expenses should be included in SOPL unless relevance or faithful representation would be enhanced by a change in current value of an asset in OCI. Okay, then only you show it in OCI. The second of these relating to the recycling of items in OCI into profit or loss. IAS 1 presentation of financial statements suggests that they should be disclosed as items to be reclassified into profit or loss or not reclassified. So there should be a heading. The recycling of OCI is a contentious, and some commentators argue that all OCI items should be recycled, whereas others argue that they should never be recycled. Some argue that only items should be recycled. So there is basically narrow view, broad view as well on that. So there's an argument. So there is not a logical, basically a particular logical explanation about which items should be recycled, which should not. So, but still, what you should consider is that if it provides relevance and faithful representation, then you should do accordingly. The framework contains a statement that income and expenses included in OCI are recycled. When doing so, would enhance relevance or faithful representation of this information. So OCI may not be recycled if there is no clear basis for identifying the period in which the recycling should occur. Okay. So OCI may not be recycled if there is no clear basis for identifying when the timing of that recycling would occur. Okay. So as I've said earlier, so what you would do is that you would use relevance and faithful representation. Okay, so that's basically what is contained in this new conceptual framework. So let's recap. All these things are same. So just this thing has been introduced a bit, even though it's already there. Management stewardship, and then after that, in qualitative characteristics, what they have referenced is explicit reference to prudence and substance over form, and then in reporting entity, It has given the description of reporting entity, and then the perspective from which the financial statements is prepared, not only for one user. And then the definition of assets and liabilities has been changed. Earlier on it used to be expected, whereas now it is controlled, and then after that potential. Okay, so in case of liability as well, the definition has been changed. So expected would have why expected is removed is that some people were interpreting it as a threshold, so only some items above threshold should be recognized or not. So that's what these were the basically misconceptions, or basically the doubtfulness that people used to have. So those have been addressed. So it makes clarification on the definition of assets. So even though these are not about definition of assets and liabilities, rather it's about criteria for recognition. So in case of recognition and derecognition, so what they have normally done is that these three objectives should be met. So they have changed the quantitative factor to qualitative. So the probability criteria has been removed. So if there is a potential, or if it represents properly, if the information is represented properly, then you actually recognize it. Okay, so in case of derecognition, what they have normally done is that this was not addressed by previous standards as well, and then so it's retained after the particular transaction, assets and liabilities which are retained, and then the changes in it. In case of measurement, what is as said is that so it should be entity specific information, not only just standardized descriptions that normally companies tend to make, just copy paste. That should not be there. So it also talks about historical cost, and then three other measurement of current values: fair value, value in use, and then current cost. So fair value is the exit, fair value and value in use the exit value. Current cost is the cost of replacing or buying a new particular assets. So in this case, what it says is that relevance is a key issue. And then it also mentions which items should be used as historical cost, which is should be used as other costs, other methods. Okay, so chapter 7, in case of presentation and disclosures, it talks about OCI. So this also has been replaced by if it represents more faithfully, relevance and faithful representation, and then if the timing cannot be determined, then you can actually show it in other places. But still, like, there is not a particular clear basis for identifying which items should be reclassified or not. So there is narrow view, broad view as well. So basically the IFRS particularly says that it should be kept under this, and then the heading should be particularly given clearly. Okay, so this is it. That's the changes that have occurred in our conceptual framework in 2018. So I guess I have covered pretty much all of it. If you have any other questions, please do comment down below. Until next time, bye bye.